It's go time.
All righty.
On that note.
Brett, you
Hi,
want
everybody.
to
Hang on a second, Norma. Good afternoon, everyone. This is Brett Johnson from the Transportation Center. Thanks to Joan Pinnell for setting up our webinar today with Tony Hatch. I'm going to turn it over to Norm here in a couple of seconds to introduce Tony, who many of you normally join us annually at Maggiano's, downtown Chicago. Unfortunately, we can't do that this year. Hopefully we'll be doing it with you next year. And I don't want to say hopefully, I know we'll be doing it with you next year. Just before I turn it over to Norm, I would like to let everyone know we've got over 100 people on the webinar now. We are going to have time for Q&A at the end of Tony's remarks. And the way that we would like you to do that is on your Zoom screen, there is a Q&A icon at the bottom. And please submit your questions through the Q&A tab, and I'll work with Norm to read the questions to Tony when we get to that point. So I'm turning it over to you, Norm.
Thanks, Brett. Can you hear me? Did I get unmute properly?
You sound fine.
Oh, very good. This is a tradition of having Tony with us at Christmas, and it's become somewhat of a family for the group that gets together at Maggiano's, and we have, I understand, over 160 people listening to this today, which is just wonderful. Tony has a grasp of the railroad industry from a financial point that few people do. We always appreciate his candor and what he says, and he certainly backs up his opinions on things. We did have Tony's biography. You can read that certainly in the announcements. And with that, Tony, please start letting us know what you're thinking at this point. And we miss seeing you in person.
Well, thank you, Norman, Joan, and Brett, and Northwestern. This is certainly, it's really the highlight of my year. And I'm really sorry to be doing it virtually. I'm happy to be doing it virtually, but sorry, it really is the last big thing I do. It reminds me the holidays are here. I have made up a bowl of rig a la Tony here. Didn't get to finish it, so it's just like if I were actually there. So I'll put it down. And I would say I'm really sorry not to be there. Given that it's gotten cold, I do want to point out that it does save me from that rush to O'Hare and maybe missing a flight and having to spend time in the O'Hare bar and getting as drunk as a White Sox manager. That was a shout out to Rob Hart, who I hope is listening. And I just wanted to say, speaking of baseball, I have a couple of things first, that some of you may notice they did play the season, and I'm very happy about that. I'm also happy to be just out of my third quarantine of 2020. So I hope all of you guys are safe out there, and happy we are here. We just, the whole abundance of caution, that's a phrase I look forward to never having to say again. I'm looking at here at my notes, and then I'll start the slide thing. I have a report on the conference that I run with Progressive Railroading and Rail Trends that will go out to all of you who sign up for this. Just as an FYI, I'll address some of the issues on it in my talk. And so this really is going to be, I mean, I will be writing still to the end of the year, but the last time I'm going to be Zooming that doesn't involve my niece opening her presents or something. So I want to say thank you all for having me, and I'm going to go into my presentation. We're going to see if this works. Let's see here, and now I'm coming down to here, and it does. So with that, I'm going to start up right away, and then I'll close with a couple points that we learned in the last few days since I put these slides out, et cetera. You know, obviously some things have happened, and we'll talk about some of the big pieces of news you may already be aware of and have opinions on, and others you don't. So I'm here with my, see if you can see my cup of Joe. Hopefully all you guys are too. You're bundled and warm, and we'll start right away. You know, thank you everybody for the year who's been. This is going to pass. Eventually it will have an impact long term, but really as a trend accelerator. I'll talk about that. I always like to start with this because a lot of what I'm going to talk about rotates around these 5, you could even argue really 6 enduring rail advantages. The labor advantage that railroads have that is coming into play now with driver shortages coming up again and tight truck capacity. Just think about a double stack intermodal train. out of LA Long Beach, versus the number of truck drivers it would take to move that stuff. Think about the fuel advantage. The Association of American Railroads always calls it a 4-to-1 ton-mile advantage. It's probably less with advances in technology, but clearly, railroads are much more fuel efficient. And with that, and really these days, in the days of ESG investing, and I'll talk about that a little bit, it's a huge environmental advantage. They are much more emissions efficient, for example. And while railroads themselves look like big dirty things, there's just one of them running steel on steel versus all those trucks. Those 2 or 3 advantages are all being, in essence, attacked. I like to say under the Trojan horse of safety. People from Elon Musk to the guys at Waymo and all these others, Too Simple. We can even talk about Nikola, and I'll talk about that in a bit, are all fighting, in Silicon Valley and other places to do things that make either electric vehicles or autonomous vehicles that take away these huge systemic long-term advantages railroads have had. So railroads have to really react to that. And I would say they can because of 2 big defensive characteristics they've got. One is the infrastructure advantage, and rail infrastructure, is self-financed, as we all know. It's in very, very good condition right now, as we all know. The highway is not, as we all know. As we change administrations, we are thinking about whether we'll ever get an infrastructure bill done. The FAST Act was merely extended till next October. The Engineering Society gave the highways a D- rating and rails a B. This was once a big disadvantage when railroads were funding theirs and the highways were being built in large part with public monies, somewhat supported by tax. But that tax, again, is on diesel fuel, right? Which is, as trucks get more efficient or become electric, and cars, the same thing, are not going to fund it. So the whole advantage now, the political fight over infrastructure, is advantage railroads, and probably as close to a permanent one as you can get. And then the 4th and 5th are really related. Railroads are in excellent financial condition. They handled and are handling this incredibly wild slowdown and then recovery. We'll step back in the fullness of time. Yes, there are issues of congestion and whatnot, but they're handling this really well, and they're doing this with cash flows coming out flat to up, and basically they're coming out of this in an even stronger financial position. And well, that means on the same hand, happy investors, and I'm not here necessarily just to talk about that. That also means the ability to fund challenges, right? If they are being challenged by autonomy, if they need to invest in technology, they don't need to borrow at usurious rates. They've got the money. So let's look at these points just as we got into rail trends, and which was just a summary of where we are year to date. The trends were accelerated by the COVID-19. Really, e-commerce exploded. It was always growing at rates that were unimaginable by rail standards, and now all of a sudden it's really, as we know, it's just absolutely exploded. And I think that's actually, while challenging, is actually a positive for rails. I list nothing really happening here for energy, but coal numbers were doubly worse this year for reasons I don't fully get, and we know what's happened as well with anything related to crude by rail and fracking and ethanol, as the driving season was completely mostly gone away. Technology I'll address, threat and opportunity. One of the things that's going on right now is we don't really know. There have been so many odd things in the last 2 or 3 years, with this year being, of course, the worst and most complicated. And I'm referring before that 2019, as I'll show you later, was not a great year. We've had trade wars going on, which really are important for rails. Now we have this recovery. How much of that is what we call inventory restocking? How much of that is a permanent change in the way we shop? How much of that is buying more things because you can't buy more time, like a movie, ticket or a baseball ticket? What is secular versus cyclical versus pandemic? And then we have all these other, off-network issues I'll address. I've covered a lot of these takeaways of current events, and with the CN luck was really entering this year with the strikes and blockades. And I want to point out that the blockade in Mexico is finally over. Both in Mexico and in Canada, there were blockades that greatly impacted railroads that I follow on issues that had nothing to do with them. But the nature of the way their governments work, as opposed to our Interstate Commerce Act, meant that one way to get attention was to blockade a Kansas City Southern train, or to blockade a CN train if you wanted to talk about indigenous rights or teachers' rights. And so that's really an odd thing that I'd never really thought of in years past. The trade wars are certainly not over. We have 370 plus $billion in tariffs on Chinese goods. I have reason to believe that we are entering a period after the last few years of stability, and stability is really good for investment. Stability is really good for railroads when you run a long-term business. So I'm really hopeful that the trade wars, if not over, certainly aren't getting worse, and over time will get better, and certainly will get better as we talk about our allies, and that includes our NAFTA allies, who we have various times put on tariffs and whatnot. The energy commodity price collapse, it's for smarter people than me. Is it permanent? We had hoped that we'd have an inflection in the second half, and we did, right? But not a normal one. We thought after all these wild years of truck capacity issues and then truck overcapacity in 2019 and whatnot, that with trade wars and harvests, that 2020 might be a good base year to see where are we really at here as a rail industry. And obviously 2020 is the farthest from a base year. The election uncertainty has been, in my mind, ended. And I think that provides real opportunity. It does have threats too. And I'll talk about that in a bit. But as any changes, also keep in mind that even after January 20th, which is should be a national holiday, not just because it's the inauguration, because it's my birthday, that we nothing will change on the 21st. It takes a long time to staff up the FRA, the DOT, et cetera. These things are not rapid. And so I would expect that, the course of 2021 to be sort of a learning year for government, but I do expect less, craziness. So anyway, the first half financial results were solid. The third quarter came in a little below expectations, but that's because expectations were too high. The railroads have really done a very good job, and I'll cover some of this. The PSR progress has been central to that, and I think PSR 1.0 is almost entirely behind us. And lastly, succession plans are still unresolved. Obviously, this is out of date. BNSF has given us a succession plan, but we still have issues, at CSX just because of, older, and I hate to say that at my age, but as CEOs get towards that retirement era, there's not a clear, follower as we've often had in the past. There's not a clear, succession plan as we saw with Hunter to Keith, for example. And this is true at Union Pacific. It's true if Keith were to decide, for example, to move. It's true at CN, where JJ is getting closer. I mean, really, we're at a period where maybe by next Christmas, we'll have to talk about a whole lot of new people. So I'm not going to, focus a whole lot on this. Whatever you think of PSR, we'll talk about it. It's certainly good that it was all really started in 2018 and 19, so that the railroads were not in a process of creative destruction when we came into pandemic destruction. So you could look at this at your own thing, the continuing cult of the OR, which means how do you spend your cash, buybacks versus CapEx, the hype of technology, which doesn't appear to be imminent, but it, is out there. There are all sorts of things here we can talk about. One of the big issues going on within the rail world, and some of the listeners care a lot about this, is the allure of M&A in short lines and regionals. The pandemic did nothing whatsoever to tamp down the interest in short line assets. That it's got a cousin, kind of the cousin you don't want to show up at Thanksgiving, which is the value trap of rail consolidation. I truly believe that big rail consolidation would be a value destroyer. We could talk about that. So most of these are Q3 numbers. We saw, operating ratios decline in the third quarter. Again, I talk about the cult of the OR. The operating ratio is a really important number. It's just not the only number. And I'll address that over the course of this. And for some reason, I don't, ask me about it. But I think that's a pretty good performance here. These are Oliver Wyman numbers that I'm using here. The revenue per unit story is interesting. Now, this is yield, not price, but it does lead to some questions we could talk about what's happening in the differences between, say, BNSF, which reports but not fully, since it's Warren's toy, his one-to-one scale railroad he plays with, and Union Pacific and how they compete over things. But the really interesting things is the cash flows were up for almost all those carriers. You can see the list, and capital expenditures were down. If you look at some of them, that's really why cash flows were up. Now, CN is the one that I want to just point out here because it looks dramatic, as if they reacted or overreacted perhaps to events. Keep in mind, they were in a multi-year, 2.5 year or so, a catch-up plan in their Western capacity issues. And so they were spending at 25, 26% revenues and had always planned in what was expected to be a, quote, normal year of 2020 to sharply reduce capex and still be down around the 20% ongoing range. So when the Canadians talk about reducing capital expenditure, you know, I don't feel I need to investigate carefully, and I'll show you why later. They're perfectly willing to spend to fund their growth plans. Rail stocks have done well. This is, you know, my stakeholder group. It's not the be all and end all, and I will definitely argue that railroads are in thrall only with their short-term stock price. But if you look over this is over the fullness of some very odd and troubling times, from the railroads not quite being able to handle truck capacity issues in 2018, to truck overcapacity, to trade wars, to the NAFTA, you know, disruptions, to blockades, and to the pandemic. You know, it's really good. The, you know, operations are seeing a little improvement, Oliver Wyman wrote, and I'm just going to argue this is a pandemic. The railroads have never had to face the shark's tooth of the decline to almost zero, for example, in auto production, and then to match that up with a recovery back to 90% of it or something, for intermodal to drop to zero, and then to recover to being in positive territory, significantly positive territory year over year in the fourth quarter. It makes for, you know, this is an industry that's more flexible than it's given credit for, but usually is not flexible within a quarter. And so I actually think these are good numbers, not numbers showing little improvement. If you look, you know, carloads were down. If you look at the course of this quarter, and I'm not, you know, you can look at this at your leisure. But what I really want to show you here is that this has been a strange year that didn't necessarily fit quarterly delineations. The drop, the pandemic was sort of underknown by the end of the first quarter. It really crushed the second quarter and into the third when we saw the recovery and intermodal. By the time of the end of the third quarter, volumes were up or close to it. Certainly they were up in intermodal and down in the low single digits in carload, and that includes coal, right? So, you know, this has been an incredibly unusual year that makes this slide almost useless. And look at the coal numbers. I mean, look at these coal numbers. And this is just the third quarter, but we're looking at, you know, numbers of down 32%. The coal decline started a decade ago. It is irreversible at this point. Excuse me, having a little rigatoni issue. I'm back. And intermodal numbers are much more interesting. And keep in mind that the fourth quarter numbers are all going to have plus signs in front of them. This reflects the end of that sawtooth. So I addressed short lines, and I want to spend a little more time on them. I spend as much time as I can, given that they're, you know, now entirely private companies. There are still a ton of small, what I would call non-auction deals that are simply announced with a press release. You know, there's more activity. The increase in valuation, the demand for shoreline assets has created supply, retiring owners, industrial companies, et cetera. And speaking of industrial companies, a new prototype might have been set by the Watco Dow deal, which I think is really, really interesting, where Watco will handle all of the, see if I get this right, and I know Stefan is listening, behind the fence activity, and essentially bring PSR to the plant, especially in plants like the chemical industry where you have multiple moves within a plant. There's still the U.S. Steel Lines. Pan Am Railway, I'm going to address that at the very end, is no longer on the market, as you know. That was really remains a really interesting story. There was a smaller deal out of Salt Lake that Patriot Lines acquired. So there's lots of stuff out here. The spanner in the works, which really has more implications for bigger deals, in my opinion, was the STB's 2-to-1 rejection of the CSX sale of their remaining piece of their 6 original lines they were going to sell post-Hunter, post-PSR. The Messina line to CN, there were conditions put on that said, CN said, I don't want it with these conditions. That deal is still potentially changeable. We're about to have a full STB with 5 people. It went 2-to-1 against, if you will. But my thinking is, and Mike Smith, if you're listening, you know, if the Finger Lakes can hold up a deal between 2 Class 1s, what is going to happen if you talked about, you know, 2 big U.S. Class 1s merging? I mean, you know, we're having a fight about the Messina lines, and most of you probably never heard of them before yesterday. The buyers here all come with different costs of capital, different time frames of their investment, and different return on investment expectations. And you have strategic buyers, you know, that's Watco buying something as a strategic buyer. Shortline holding companies buying other shortline holding companies, as Genesee and Wyoming did for a while. You have private equity, which usually has a sort of a 3 to 5 year horizon. And then you have infrastructure firms, a cousin of private equity. And I just want to point out, when people say, how are they paying these numbers? That these guys have almost free money. They have a 10 plus, into the 20 years kind of time frames. And therefore the return expectations are much less. They don't need to goose the company up and fix it and then resell it, to another PE firm. This is truly an infrastructure investment. And I think you would put Brookfield buying Genesee, Wyoming in that category. And these are guys out there that have roiled the market. In fact, you could argue that Genesee and Wyoming sold because of the real arrival of these guys. How could they compete with people with a cheaper cost of money, with as or longer term time frame compared to a public company, right? Infrastructure firms have the longest investment horizon outside of you guys out there in the audience and your houses, longer than the public markets, and that's tough to compete with. Kansas City Southern was approached by a combination of infrastructure firms who generally can't go hostile. Kansas City Southern said no, as I expected. And so that deal appears to be completely dead. Some have thought, well, why don't the infrastructure firms buying the smallest of the class ones, which is about the biggest they can buy, just to point out. That's about as large a bite. So don't worry about buying $120 billion market cap Union Pacific. I mean, that's just too big. But why didn't they bring in CP, let's say? That was a rumor that went around. And I would say the minute you bring in a railroad, you bring in the Surface Transportation Board. And if the Messina lines, how much more complicated is that? And then you have the question about class ones as sellers. CN is selling lines nearby you all out there in Wisconsin, as you know, part of the old Wisconsin Central deal they did long ago. But you have CP and CSX actually now buying extension lines. If you remember the original CN as the mothership of PSR pattern, they bought short lines when others were selling them back in, they bought BC Rail, Great Lakes Transportation, Wisconsin Central. I'm sure there are others I'm not thinking of. And this pattern, I think, is being replicated in the, the two Canadian PSR 2.0, motherships out there. So the question about class ones, there's certainly not a rush for class ones to sell lines as I thought might have occurred a few years ago, especially at the beginning of PSR, as would happen at CSX. I'm not going to spend a lot of time on this. I've already covered it. The one thing I thought where I might be wrong was if you were a class one railroad with an eye of buying Kansas City Southern 10 years down the line, you might have thought to be shaken out of the woodwork by the approach by Blackstone and GIP because, they could have been off the market for 12 or 20 years, but nobody was shaken out of the woodwork. And so I don't think it'll happen. What happens in a big rail merger is all the rule books get to be rewritten any way you want. And that includes, I think, access and lots of things that would destroy value. And keep in mind the value destruction. The mergers that created the so-called Big Four were successful and necessary, but they weren't easy. And so I just want you to remember that as we think about this. Basically, that's what I've just covered here. If you look back a few years ago to the efforts of CP to buy an Eastern Railroad when Hunter was there, it goes to show you everything you really need to know, which is that of the 5 or 6 major stakeholder groups that have a say in this, 5 were against Hunter and CP buying Norfolk Southern and CSX. And that included labor, regulators, shippers, unions, legislators, communities, a lot of whom remembered the hassle in the still ultimately brilliantly executed J line, not the deal, but the acquisition of the J line around Chicago by the CN. The only group that cared about that was in favor of this because they loved whatever Hunter Harrison did were the shareholder group. And we have always thought we were the only group that matters. And we know that's really not true. And so when Hunter decoupled himself, if you will, from a railroad, all of a sudden the only group you needed to please were shareholders. And lo and behold, boom, he got to go to CSX. That could happen again with an activist investor. I'm not suggesting, I don't think it's clearly not at CSX, but I don't think it will happen. But I'm just trying to point out to those of you who talk about rail mergers, that merger was never going to happen. It's also kind of silly to think about CP as the buyer. They are a wonderful railroad, but they're a really pretty fluffy tail on, trying to attach itself to a very big dogs. Joan,
Yes.
can you hear that?
Hear what?
Okay, I'm hearing myself come back to me from 5 slides ago.
Interesting. You're hearing like a,
I'm hearing my talk on my computer. It is playing back what I said about slide number 3. So I
I'm
apologize.
hearing
for
an echo now. I'm hearing an echo now. So let me, I'm gonna mute you real quick. Hold on. And I'm looking.
Perhaps he just needs to turn off his computer sound volume.
All right. Can you hear me? Good.
Yeah, I can hear you. I actually think it's because, Brett, were you unmuted before?
Yes, I've
Might
been
have
muted the
You
whole
might have been
time.
hearing someone else's computer.
All right. I'm not hearing it. It's all good for me now, as long as I'm
Okay.
heard out there. And I apologize for this.
Just a brief interruption. I'll go away now. Bye.
Okay, so sorry about that. For maybe those of you who didn't hear, hearing myself was really awful. So I really appreciate you all out there in Greater Chicago listening in. That's very nice of you, because I couldn't do it. I couldn't listen to myself. 2019 volumes are scary. I just want to talk about, when we talk about comparisons, and later on next year, somebody's going to say, "Look at our volumes were up." Remember that these are always year-over-year comparisons as well as sequential. And I just want to point out, in the last, 2019 was a year that we couldn't wait to see the back of. Little did we know, right? But here you can see, the reasons why, and really the trade distortions are the biggest. I want to point out that the AAR, which does such a great job under Ian Jeffries, constantly talks about trade being associated with 42% of rail volumes. And I want to point out a couple of things. One, that's 2014 data. So that's all automatically very old, very wrong. It does not include Canadian National, Canadian Pacific, Kansas City Southern. It does not include the inputs into U.S. exports. For example, fertilizers that go into corn in the Midwest that is then railed into Mexico. Corn is the largest imported product into Mexico. It only counts the corn. So, it's for the rail world in North America that I follow, trade is 65% of the business. So this is why I keep harping on this, not just with my citizen hat, my cup of Joe, if you can see it, hat, but really as a railroad person. I want to see a restoration of normal trade patterns. Trade means movement. Movement is good for railroads. So, Joan, I cannot now move my slides.
What's happening?
I don't know, but if you could just go to the next one, can I just say that?
I can't, because I can't actually control your slides, but
So we practiced this, guys out there. I just want you to know we did, and then I had a technological issue yesterday. We did a lot of work to get this right, and so I apologize.
here's what we're gonna do. I want you to stop sharing real quick.
Right.
Don't share, or you
Brett, I got this. Let's do one directive. I want you to start resharing again. So click the share screen.
Yep, coming. I'm just not that fast.
It's okay. And then we're going to go back to the slideshow presentation, or you can find the slide you want to start back on. There you go. Now do your arrow keys. You are muted now. Asked to unmute. Okay.
All right. No movement.
Okay. Can you hover over the slide with your mouse?
I'm hovered over the side of my mouse.
So can you click next with your mouse versus your arrow keys?
I don't know where I would do that.
Does a toolbar pop up when you are hovering over?
All right, it moved.
There you
So, okay.
Okay.
So I apologize, guys. So the share of electricity, these are going to go quickly. Hopefully I can move them quickly. Just look at the coal slide, and the EIA expects it to actually go up a little bit next year, but that is the classic dead cat bounce, saying this is a cat lover, so it's a terrible phrase. But don't, if we see coal up to 20% of the total, don't think we've seen a comeback. It's not happening. Higher profitability, capital spending. I've shown you slides like this before. The real tie to capital spending on railroads is their anticipated return and what they're going to do if they were to get new grain cars or build a new terminal or a new siding to make longer trains. It's the anticipated return. They need the net income and the cash flow to spend it without having to go to the bank. They can certainly have lots of access to capital, but this is really sort of it says correlation is 71%, and I'll believe it. The operating ratio, the big boom in capital spending that we'll show you in a bit, is very much tied to this, right? Reduction in derailments, reduction in any kinds of inconsistencies That, the operating ratio is tied to CapEx. This is something I need to remind my stakeholder group all the time when they want to see that money go into share buybacks, is that you like the operating ratio, but these things aren't free. Just wanted to show you, and all of you in Chicago know about this, capital spending and maintenance expenses. If you put them together, these are big numbers, right? This is expensive business to be in. Here's the return on investment. This is the actual return on investment from the AAR. This also doesn't include the Canadians, and we'll cover that in a second. But the point is here's a pretty good correlation. This is actual, but it's really anticipated. We'll talk a little bit about highway challenges and some of the work that Oliver Wyman has done. Matt Rose, when he left the business, basically left a couple of things out there. He didn't think he saw mergers for a decade, and he also thought technology was a threat and an opportunity, but that given the size of the markets addressed, railroads would really have to do it on their own. To some degree, he's wrong. And I'm going to say this, and I hate saying that about a good friend and somebody I respect, but I mean that, yes, Google and those companies do work with rails, but if you look at where they spend their effort, the size of the vehicle miles versus rail miles traveled, the reason they're working on autonomous trucking is because it's an enormous market. So that's what he means by this. With momentum lost because of COVID, I don't really think so. I think actually it's been a really good year for rail technology, which is another sign of railroads, while dealing with this horrible pandemic, of looking ahead. I mean, when you see some of the investments they've made, the hires they've made, et cetera. Railroads have always been a technology-driven industry. It's just never really given the credit, and they often hold on to technology for a long time. Because railroads operate 24/7, 365 like a casino, right? Somewhere there's a guy with a punch card in the basement in Omaha or Jacksonville or somewhere. They never can turn these things off. And when they try to switch from one to the other, it's not always successful. But, they need to, all these things you see here are absolutely true. The response has been mixed. PTC is at 91.6% interoperability capability for the US rail system. That's amazing. That is the key to what some people are calling 0 to 0. When you add on a trip optimizer or leader or something, you can literally are very close technologically to running an autonomous railroad. So the question really, to run a one-to-one scale railroad in, with real scenery instead of scenery you get from model railroader. You can do all this pretty soon, except for regulatory and legislative issues. And I'm going to try to address those as well. But, the railroads must get there before trucks. And if they do, I think there's a whole new way. So much of the decision made based in the DNA of railroad managers is based on the cost of the locomotive, the cost of the train start. And if you take that away, even though taking people out of all of transportation is a huge catch up to trucks, remember that 300 containers versus 300 drivers and all that. You can run short, fast trains. You could do all sorts. The whole game has changed. There have clearly been a lot of successes in the last few years on what I call the defensive side of the ball, using a football analogy, car and track inspection and all that. That stuff leads to more consistency, but that leads to something you can sell, right? More reliability. Those are things that can be sold on the offensive side of the board. But you're still seeing, a focus on operations-driven technology, and I want to see more offensive one. You have a chief innovation officer at KSU, and you have Brian Hancock, whom you all know, and you have two new hires that are really interesting at Union Pacific, coming from Walmart, and at Canadian National, coming from Bombardier and from Wabtec. This is a really interesting, bringing in outside ideas. It's a whole new ball game. The pilot program has already been surpassed. Rail Pulse is a potential game changer. Two local folks for you, or for some of the founding members. It's Norfolk Southern, Trinity, GATX, Watco, and Genesee and Wyoming, and they control about 20% of the fleet. This is a way of bringing visibility into the carload business in areas like the paper business, a many-to-many business, a classic case of this. It's been necessary for a while. I do want to point out to those that in my stakeholder group who say, well, why can't railroads be like FedEx? They've had package tracking for decades. And I would argue back that, well, FedEx is a closed loop, right? They don't have UPS packages to track. They don't have empties to track. They just stack cardboard in an office. It's a very different phenomenon. It involves this Rail Pulse thing is a diplomatic achievement on on the verge of like the Versailles Treaty, and that actually failed, so that's a bad analogy. But you know, it's a huge way of getting all these different stakeholders to think about a network problem and a network gain. So let's see if I can click. Yeah, this is the cost of capital and the return on invested capital. And I want to point out there are huge problems with these numbers, in that they're done by the STB, you know, with whom I have great respect, but they are also therefore slower, right? And they involve only the U.S. operations, and railroaders and shippers and shareholders view North America versus the U.S. So this includes, you know, the CP's U.S. operations, but not CP as a whole, as an example. In addition, I think their cost of capital has been strangely high. You know, this is an art, not a science. So, but the point nonetheless is, and I want to point out two areas here. After Stagger's deregulation, you saw reasonably steady, erratic, but steady improvement getting towards that zero line that was then ended in a period of the mid 90s into the early aughts. So what is that? That's rail mergers, right? That's just a stagnation of that progress, which then in the rail renaissance has turned into positive numbers. If you don't earn more than the cost of the money you employ, you are destroying value. It's a classic business school case. Many investors would have looked at this chart, you know, in 2005 and walked out of the room right there saying it's incredibly expensive and you don't get paid back the money you put in. I would always try to point out that that was going to change. And in this case, for a rare thing, I was right. Here's another way of looking at that chart. You know, I should have the 18 and 19. 18 is in there, the 19 numbers, which were, you know, again, positive. Again, it's useful, and it's useful because this is something that's used by others. And it's really a directional chart because it excludes carriers that I think are very important. The return on equity chart is not quite as advantageous. So sometimes the rails like to point at that. But let's just talk about the Canadians here, for example. If you look back in the last 3 years, and you can include this year, the Canadians have spent more than any other carrier on a per capita percent of revenues basis. Maybe Kansas City Southern would argue about this, but their returns on investment have been better than any of the, you know, than the rest of the industry. And in fact, in the last 12 months, CP's had a return on invested capital north of 17%, which is better than the portfolios, in my mind, of the owners of the company, better than the equity portfolios of people like the Children's Investment Fund who own CP shares. So, you know, I'm not saying that if you spend, you will have a higher return, but I can clearly tell you that if you don't, you won't. And so a lot of the pressures to reduce CapEx to below 15%, that's really a big thing in what I would call PSR 1.0, and it does create the capacity dividend. You've reduced, you know, you work your assets more, so you need fewer of them. But I do believe that this spending has been entirely responsible for the explosion of intermodal progress and opportunity. It's been entirely responsible for, you know, the safety improvements, the, you know, OR improvements, and the Canadians, I think, show it to the best example. You know, prepare for a post-COVID world. As we can see here, you know, PSR efforts should be maintained. The railroads are all, whether they're willing to admit to it or not, moving to PSR 2.0, what I used to call tongue-in-cheek the PHR, or post-Hunter railroad. When after a few years of shrinking maybe your business, look at CSX, maybe to a lesser degree Union Pacific Intermodal, you then have a new, you know, more profitable, smaller bit that you turn around and grow. What CP called was a multiple years of inward focus and fixing the engine, and then a pivot to growth. And that's where I think that we are, and that's really where I believe we could. Doesn't mean it will happen, but it means it can. And I think if you look at the COVID period, when you saw railroads' use of extra boards versus furloughs and others to prepare for what they saw was a recovery, when you see them spending on technology that has multiple year payout periods, you know, you knew that railroads are not focused on quarter to quarter earnings, that maybe even COVID allowed that to be rethought. The very short-term part of their investor base is always a small, loud piece. Investors run the range from traders, day traders, to people who want to hold it for 20 years. So just remember that railroads, I think, are really preparing for a post-COVID world. I have a few things to go before we go to Q&A, because rail trends was such a big deal, but I really want to point out just a couple of issues that have happened. I'm going back to my notes to the report that you all will hopefully get. There have been three, I think, really big deals that have happened. You know, one is Canadian Pacific, as long promised, now has a steamship line calling on St. John, which they can now access through their C&Q deal. Both the CN and the CP are developing Eastern port access. They've already had it, Montreal, and in the case of CN, Halifax, but they're really focusing on creating what CN likes to call an Eastern Rupert, after Prince Rupert. Part of this is a hedge on China. I don't see a lot of nearshoring or onshoring happening outside of medical devices and whatnot, but everybody's talking about it. And if things start going through the Suez, railroads better prepare. And so that's, I think, a pretty big deal. The second big deal is that CSX bought or has announced the deal to buy. They're going to file with the STB, the Pan Am, and that NS is probably a little chuffed about that, or chuffed is the wrong word, is not as annoyed. It's really an interesting business. I'm happy to talk about it. It follows the old CN pattern that Jim Foote, when he was chief marketing officer, saw when working with Hunter there. It's a line extension. It gives them access to St. John. It allows them to play in what was the main paper business, deader than a doornail, and not so much anymore thanks to e-commerce. I do want to point out in the intermodal growth boom that one of the biggest components has been what Larry Gross calls short trailers and whatnot, the pups and whatnot. That's e-commerce. Railroads are playing in e-commerce. I believe they can, and paper will be a big part of that. I'm very surprised that Genesee and Wyoming didn't play a more active role in the pandemic, but that's been a really interesting story. And then apologies for blocking it off. And my last little bit here, I talked about the Mexican teachers going off the rail lines. 2 railroads have been reportedly, and only one has really admitted this, invested in Too Simple. And I think that's something that's really interesting. Railroads investing in technology of the introduction of Rail Pulse. You have all the work done on inspection portals, and then the CN and the UP potentially investing in Too Simple, which is probably the leader in autonomous vehicle trucking technology. And there, if you look at their website, it's all pictures of long haul trucks. So, is this a sign of Sun Tzu, the great Chinese, war leader, author who wrote "Keep your friends close and your enemies closer," or is it something they think they can apply directly to their own base? It is certainly a sign that railroads are thinking outside of the box. I hate the phrase, and gives me a lot of hope that the long-term thinking, the use of their accumulated financial power, the power of their network, can all make them as relevant in the next decade as they were in the last. And with that, Joan, Norm, Brett, thank you. I'm ready to take questions, and I think I'm about on the time you wanted me to speak, despite technology.
Yes. Thank you, Tony. Will you stop sharing your slides, please?
I am going to stop sharing my slides.
And Brett is going to be handling Q&A, so I'll dip out again.
Norm, feel free to join if you'd like. So far, we have 2 questions, Tony, and they're more or less related. So I just want to ask the audience if you have any other questions. Just a reminder to send them in through the Q&A tab, and one just came in. So Tony, here's the first question.
Yes, sir.
George below asks, coal is now a smaller revenue stream. Intermodal appears to be questionable from an intercontinental volume perspective due to major changes in the routings of container vessels. What future revenue strains are there to consider for investment in railroading? And related to that, Eric Herm asked, how will rail companies adjust operation as coal continues to decline?
So I think the railroads in many ways already have. There are probably more shoes to drop in terms of changing your operations as things change. There are lines that are completely dedicated only to coal, and we'll see how that plays out. If you think about the flexibility of the railroads and how inflexible and how modern and sleek trucks are and whatnot, if you think about the railroads in my time, my 30 years of doing this, at what point the auto manufacturing cycle was so important to them. Now it's still an important commodity, finished vehicles, and in some cases auto parts, but it's an assembly business. They handled that. Coal was the bedrock, and that really started. I mean, the crossover line was several years ago. And it's, as far as investors are concerned, that's we're at finding the last Japanese soldiers on islands. That war is over. So I would argue they already have. They bristle when you say, well, they're developing intermodal to compensate for coal. And they would say we would always fund growth. Even when we were funding the corridor system in Norfolk Southern when they thought coal would last forever. I disagree with the first part or the second part of the first question, which was intermodal. Intermodal certainly has challenges, but and some of them are port directed, right? But if you saw a huge jump in share back into the West Coast in the recovery of intermodal because of what Larry and others call the need for speed as you're restocking your shelves. So LA Long Beach regained share, some of which they've now given back. But I think it's, LA Long Beach is always relevant, but it might be, I really think what I thought in the beginning was that you're going to see a bifurcation of international intermodal by value. The more valuable it is, the more you want to put it on the land as soon as you can, and put it on a railroad, even though you pay more, because you can save 2 weeks. So, part of what you saw with the development of other ports wasn't just, the fact they were local. It was a port diversification strategy. Everybody wants to diversify. At Rail Trends, Alan Shaw, the chief marketing officer of Norfolk Southern, gave a really good talk in which he talked about the need, shippers are going to be in some ways more risk averse after this. They've really gone, every one of these shocks from Fukushima and whatnot has caused people to rethink, how do we not get in trouble? And one of the ways to do this is to build, large distribution centers closer to the end, which have enough volume that railroads can play. So I basically, what I'm saying is I question the premise that intermodal is a problem. I think intermodal is the savior. It is hard. The standards for on time and what service are get higher every year. Railroads have to continue to play in this. I don't see them getting disintermediated by Amazon. They're carrying Amazon today, but they can be not used by Amazon. And they need to make sure that they stay relevant. I think they can. Coal is a big hit. I don't know the next silver bullet. We thought crude by rail for a brief shining moment. Ethanol had a day or two in the past. Who knows? I never heard of crude by rail before 2013, and then all of a sudden it was big. So maybe there's something else, but there's also a lot of business they can do as they get their technological house in order. They get regulatory and legislative support behind that. They can participate in a lot of business that they've lost, a lot of business that's coming new with e-commerce. I think their opportunity to stay relevant is not a sure thing, but certainly neither is their, obsolescence.
Thanks, Tony. Eric Jakubowski asks if you care to speculate on on the CEO succession possibilities for 2021-22. And Cal Silverberg wonders if you have any more comments on BNSF's recent succession announcement.
So, Eric, my good friend, I'm glad that you're here. I'm not going to fall into your usual trap on a Zoom of getting in trouble by saying something I would later regret. So nice try. I truly think, I think that all of the CEOs, now that we've gotten onto yes, we're in a second wave, but now that the crystal balls are beginning to get less cloudy, we can begin to see the future, and they are doing good things, are happy at being where they are, the ones who are in office now. But they're also, going to have age issues, legal age issues. We all know that 60 is the new 20, or what is it, the other way around. So I see issues at Union Pacific, and I don't have a exact a next number 2 person there. At CN, there's all of them have several people that will be competing for the job, whether they're newcomers to the company on a relative basis or have been there for a long time. So I see CSX, CN, Union Pacific, and even maybe Kansas City Southern, all having in the next 2, 3, 4, 5 years new CEOs, and none of them have a person involved in which I would say is the clear successor. In the past, classic example being Union Pacific, they would have moved a person to different job titles. If you remember Jim Young going from chief financial officer to chief operating officer, it was clear, when Matt made his big rise at BNSF under Rob Krebs, it was clear, right? We knew we could adjust, the relationship between Hunter and Keith was clear. I don't think we have the same kind of clear things here. And we also have the wild card of Keith Creel, who is a superstar, whose contract may be up at CP, I think next year, maybe early the year after, and may feel, not that doesn't necessarily leave a merger, but he did learn one lesson from Hunter. If he's on his own, he can go where he wants. So, what happens there? He may seek this. He certainly doesn't talk like that, like he wants to. And I may be full of what. Now, getting back to the question of BNSF, they are harder. It's like Kremlin watching. If you remember the old days, and I was a kid, so I can't say I remember this, but they would always study the photos of May Day to see who was next to Brezhnev on the balcony, and with BNSF, we couldn't always tell, right, what was happening there, how involved was the emerging new leadership of Berkshire Hathaway involved in the running of the railroad. Was it as hands off as it had been initially with Warren Buffett and Matt Rose, et cetera? We know that Katie Farmer had long been the probable successor, and everybody thought that, and then sort of a black hole. So we didn't know what to think. I'm very pleased that and then we put all sorts of rumors into the black space that we didn't have, anything concrete. And I'm glad that was all full of BS and that Katie's there, and I think she'll do a great job. And she's an intermodalist, right? So that's a big positive for me. That's the future. Unlike in the first question, I think that's the future. Intermodal and regaining carload share. I want to point out one thing that CSX has been talking about recently to give you some hope for the future for all of us, is that their stated goal under normal year over normal year, whenever we get to that, is to grow their carload business a point or so above GDP, and to grow their intermodal business at 2x or maybe more GDP. So that's the pattern I've been looking for on a consistent basis all during the rail renaissance, all during the 21st century. We've seen it for a while, and then something happens. I'm really glad to see the restoration of that kind of belief in their capability of growing. To me, that's the pivot to growth, and that's what I'm looking for. Brett, sorry, long-winded answer.
That's okay. A lot of questions coming in. From Dan Keene, what's the future of West Coast U.S. ports vis-a-vis Prince Rupert and Atlantic ports?
So good question, Dan. How are you? So Prince Rupert is a superstar port. I know that the delegation, let's see what happens in Georgia. It's sort of an answer. The delegation out of Washington State has long thought that most of the share taken by BC ports, in my opinion, has come at the expense of Pacific Northwest ports and Northern California ports. And those ports often believe that the harbor maintenance tax is a major reason behind that. I'm not so sure that's true, but there may be efforts to repeal or change that in a way. I know that in the past, that was a big, important thing that the two senators from Washington State would talk about a lot. So that's just an issue to keep in the back of your mind. The fact is that CN and CP run really good operations out of BC into the Midwestern industrial base of our continent, and I don't see that changing. I have hope that LA can retain some of the recaptured share, and that it wasn't all business that was just temporary restocking. Keep in mind that the railroads, whether east, for those of most of you know this, but Eastern railroads would much rather have business go to LA than to an Eastern port. They pick it up at Chicago, and it's long haul by their standards, and a much higher percentage gets on a train. It's 50% or so out of LA Long Beach. It's 12% out of New York, right? The rest is trucked to the local markets. And where they can do rail, like shuttles out of Savannah, it's short haul. So anything LA keeps is good for the rail business. It adds a lot to the transload, becomes, so-called domestic business on a JB Hunt or others 53-foot container. So Dan, it's a very good question. Port share has a lot to do with rail share, and they can't always control it. They're not always the decision maker for that. But, as the Canadians have shown, if they keep operating a good, efficient, and not very expensive business, they're going to keep some share.
Tony, related to that, I'm going to kind of rephrase Mark Waldron's question, but post-Panamax Canal operations, how have they changed port to rail activity?
Well, they have, both less and more than I thought at the time, and were clearly required for the development of the multi-port strategy. When I remember being on an analyst trip back when you could do all this before Reg FD on the BNSF, and we went to Long Beach to see the port, LA Long Beach, and that was long planned, hard to get all these people together. And meantime, there was a longshoreman strike at the San Pedro Bay ports. So it looked like D-Day, right? They're just ships as far as you could see. It really looked like, if you saw The Longest Day, when the Germans wake up and look out of their periscope and realize they're in a world of hurt. At that point, I believe Walmart had 80% of their business coming into LA Long Beach, and now it's a fifth. So, it's port diversification that's been a driver. In order to get that done, given the size of ships, they needed to do that. And so I don't know which was the chicken and the egg, but, the growth in the U.S. southern ports, most of all, has been spectacular. I mean, probably matched only by Prince Rupert. And, I don't know, it can't continue at that rate, but it's a good question. I don't know the answer. It has happened. It was driven by other events, but, you couldn't do major port diversification given what the steamships want to do, ships, without it. It is a lot slower, and hopefully that'll have some impact from a pro rail perspective in the future. Good question, Dan.
All right, thanks. From Richard Klossner, how important will transloading play in fueling future rail traffic growth? Is there a difference between the potential of transloading volume growth and investment between the class runs and class ones and short lines?
So that's a very good question. I assume, Dick, that you mean transloading of carload materials as opposed to the transloading you see at Port of Valley, Long Beach from 40-foot containers to 53s. Assuming that, I think it's important. It's been something that's been talked about for a while. It's one of those, magic things that never seems to have fully moved the needle. Maybe it's kept the share, but it hasn't grown it. But I think we have a new emerging relationship between the more sophisticated, marketing geniuses that run the, and I mean that seriously, that run the shortline holding companies now, and the class ones under PSR, where there's a much more important relationship, and a lot of things can be done there with transloading to regain share. So I think it is important in terms of capital expenditure. Some of the class ones do it themselves. Others are happy to let others do it for them. They'll bring the volume. So I don't know that and it's very granular CapEx. I don't know that I can see that and do a judgment and look back, say, at the capital spending of, CSX versus Norfolk Southern and try to figure out what that meant. But I truly believe that we are in a new world in relations. I know some of the shoreline guys out there may be rolling their eyes, but as Mike Miller, the Genesee, said, the short lines act as a shock absorber between the shipper and a more regimented class one railroad, and a class one railroad that doesn't necessarily have as many sales and marketing feet on the ground that the short line can handle. And one of the ways to go offline and bring it in is transloading. And I will tell you that, led by the Canadians, everybody is thinking about offline deals that can bring business to the railroads. As CN says, feed the beast, right? So they're looking at trucking companies and reefer companies. I think that is the way of the future. And transloading, is the ultimate example of that.
Somewhat related, Tony, from Matt Dietrich, further thoughts on intermodal development on shortline railroads?
It's a good question, Matt. It's harder for, it depends. There are certainly opportunities. There are opportunities for backhaul, ag products and other things like that in international boxes. There are opportunities for short lines. It's all a density thing. Can you give me enough volume for me to spend the money to do this, to stop the train to do this? If you can provide blocks, you can get added into the existing system, and especially under PSR, where some of the shorter haul or regional intermodal business can be attached to a scheduled manifest train. It doesn't need to be on a dedicated double stack, the trains that make all the calendar covers and whatnot. So I think that offers an opportunity, but you got to really define whether the value is there that doesn't, that's not within, and I'm drawing a circle in the drayage, the normal drayage zone, especially if drays get towards autonomy and electric vehicles and become more efficient. That's a potential competitor, for a direct intermodal service of, say, low density areas. But I think railroads need to grow. They should not be, they literally should think that there's no idea that's a dumb idea, and talk about this, and then work with their short line partners.
All right, I had a question teed up, and let me see if I can find it again. From Lanny Wilson, PTC was an expensive investment or unfunded mandate. Can railroads use it for other advantages in addition to safety? I think maybe one of the slides you didn't go into today, I think, addressed that topic.
So the phraseology around PTC has gone from the unfunded mandate to the future backbone of the digital railroad, and it's interesting to see how that was phrased. And John Scheib was a big leader of that and working to get regulatory change around that. And it is a key to running autonomous trains, right? The 0 to 0 that Jamie Boychuk calls it at CSX. PTC could stop the train, and then Trip Optimizer, a leader, could start the train, and you could run this train, from Stefan's basement as he runs his SB trains, right? You could do that. You could also put more trains on the same track, right? Space them closer because of the safety aspect. You're adding capacity. PTC, we'll have to look back at 20 years to see what is the ROI of PTC. PTC all had investors excited in 2004 and 5 as a capacity, addition. And when railroads like the BNSF were calling it ETC, I believe at the time, or was it ETMS? I can't remember. So people were looking at PTC already. I have to say the one thing the government may have done, I mean, first of all, they should have kicked in money. This was based on a passenger accident in California. The safety benefits are public. It should have been public money that helped fund this. But looking back on that, the government got everybody to do this at the same time and become interoperable, and made a more of a revolutionary. It's been a decade. It's been 12 years, but made since that accident in California in Chatsworth. But if it had been left to evolutionary sources and with COVID and all that, who knows? Who knows where we'd be? So maybe in 10 years we look back and say, the returns were worth it from a purely business standpoint. In any case, they're spent, so it's a sunk cost, and that has to be used from an offensive perspective. Visibility and operational control are two critical things that this can provide.
Thank you. From Carl Van Dyke, if intermodal is a future, but PSR is killing short haul and new market development, where does growth come from?
Well, I don't believe the PSR is killing that. It might have killed it in the last couple of years, but I believe that's in that inward focus period in which the butterfly is eating its. I don't know. I can't make the analogy. It emerges as the caterpillar eats the shrubs, and then the butterfly emerges, and it's called Canadian Pacific, and it's called Canadian National, and it's called Kansas City Southern, and I think it's going to be called CSX, and in a little bit of time we'll get to see that at the other two railroads that have gone this. BNSF doesn't do this, but they have sort of a different case, and I believe in many ways they're doing it anyway. So the answer is I don't think it kills it. The short haul stuff though does require a good short line partner in many cases, first and last mile on the carload side. So I don't think it has to kill it. And I know the Canadian examples are different, long lengths of haul, and after you leave Winnipeg, you don't run into a person till pretty much Toronto. But nonetheless, I think there are examples, there are lessons can be learned there that you can turn into this. So I'm not as hardcore as saying PSR is a killer. PSR is a killer at first, and then hopefully it breathes life into the patient. That's been the pattern in Canada. That's the pattern that's always been applied to Kansas City Southern as they've gone through this. If they don't grow, they're not. They're a shark. If they don't grow, they sink. So I think they've always gone this to improve service, and as Pat Ottensmeyer says, service begets growth.
Tony, another growth-related question from Paul Hoffman. As railroads' operating ratio continues to decline, how can they continue? How low can they continue to go? And can the full STB now mean shippers can push back for rate relief?
I understand where the question is going. Right now, they can only push back for rate relief in uncontracted, select commodities. So, they can't push back for intermodal rate relief. That could change, and better not. But operating ratio, I think the best way to look at this is you fix the engine, and then you pivot to growth. And when you do that, I'm going to now quote Gilles Lanoul in my French, 7 years of French down the drain, but the chief financial officer at the Canadian National, in addition to his boss, J.J. Rouet, who say, here's the kind of existential question. They said this at my Railtrans conference. Do you want us to be a $15 billion company with a 55 operating ratio? Yes, that could run into, in the U.S. side, for them, some potential pushback, legislative, regulatory, and other things. But we're also, getting more efficient. You're polishing your statute. Or do you want to be a $25 billion company at a 59 operating ratio? And the answer is clearly the latter, right? There's a lot more cash flow involved in that. So the answer is, I think we're getting darn close to where the operating ratio should go. And I think as you see PSR companies, get through their 1, 2, 3 year sort of plans in which they become this new thing, they then become PSR 2.0. CN calls it the digitalized scheduled railroad, DSR. I have also called it the post-Hunter railroad. These railroads aren't as concerned with the OR. That is a useful tool. Why did it change this quarter year over year? Well, it leads to good questions. It isn't the answer. That's where the cult has really started. And I think CN has been a leader in publicly pushing back and trying to re-educate shareholders and whatnot, that this is one of the things you look at. It's not the only thing. And note that the Canadians publish their ROIC numbers on a quarterly basis. So we need to start looking at, if not replacing it with another silver bullet number, maybe a series of numbers to look at how do we look at this thing. So I think we're close to how low they get. They could get lower. And one last thing I'll say about this is if you look at JB Hunt, the preeminent trucking side intermodal player, their intermodal division, widely considered, the best in the world, right? And I know there'll be arguments in Green Bay and other places, but let's say they're up there. They produce an operating ratio about 90, but they earn their cost of capital, right? They are a ongoing excellent business with a 90 OR. A railroad with a 90 OR would have activist shareholders climbing all over it. So what I'm getting to here is, if a railroad does a 60 OR now, and many of them are below that, right? But let's say you do 60 and a really, really good trucking intermodal partner does a 90, maybe intermodal is somewhere around a 70, 75 OR. But if it can provide a good return on investment, like that 90 OR trucking company, then what does it matter with the OR? What that does do is, as you grow your intermodal business, as in Canada, it's grown from a quarter to a third in the two railroads in the last 5 years, you have some dilutive impact on your OR, by which I mean you're growing business at a higher OR faster than you're growing business at a lower OR than your base. So your OR, maybe you still keep it down because you've done a lot of work on other things. But that just tells me the OR is one of the things to look at. We're close to the end game there, and I'm not concerned that we are. Some shareholders would flee if they thought that. I think the next phase is going to be even more glorious than the OR reduction phase.
Tony, another question from George below. The continuing critical problem in logistics, in his opinion, remains the last mile problem. Major companies such as Amazon and Walmart, along with 3PLs, are investing in that area. Railroads have few new sidings or other means of using center city access advantages. Is rail a possible player in building out that last mile?
So, I think all part of this answer is a good question, George, but what is the definition of the last mile from a railroad perspective? From a Walmart perspective, it's my house, right? Railroads aren't coming up to, the 11th floor of this building on Park Avenue. I'd love it, but because I'm a train guy, but I think railroads can play with their last mile. They're on the carload side, they need sophisticated partners, and their partners are getting more sophisticated. Things like Rail Pulse are really designed to help that first and last mile. On the intermodal side, I think drayage companies may be some of the first beneficiaries of some of the technological changes that are happening there, and that can improve it. Better terminals, faster gate in and outs, and all that. I think people are working on that. And their last mile, from an intermodal perspective, is going to be a DC, not a house. So doesn't mean that they shouldn't have tighter. They're going to be forced to have ever tighter reliability schedules, but I think they can participate. When we have to talk apples to apples. And the last mile for Amazon is a package, but up on my floor. The last mile for the railroad that hopefully brought that in a trailer on flat car was, Port Elizabeth, New Jersey, or Harrisburg, Pennsylvania, or et cetera.
Tony, since you brought up Rail Pulse, another question asked, what operational opportunities do you think Rail Pulse will create? The railroads already know where their shipments are at any given time. What additional opportunities, again, will...
Well, it's multiple railroads that, it's knowing where these things are across the supply chain, whether they're empty or loaded. And you have involved so many different actors in this, right? You have a shipper, you have a short line potentially to a class one. The equipment there is controlled by who? The shipper, a financial company, a railroad. You have that issue. You bring it across the country and potentially to another class one, and then to another short line, and then to the receiver. It's having a single source for all that data. I think that'll drive a lot of cost out. Information always drives cost out, right? It's going to be a challenge to some degree for car owners, because as PSR is, it means that if you know your equipment is, you can get it where it's supposed to be. You need less of it, but that's a savings for the shipper. Um, when I first heard about this as a pilot project at the Shoreline Conference almost 3 years ago, I never thought of empties before. We always had visibility like that FedEx example I gave. And that's because I sit in New York and I don't run railroads and I'm not a shipper. I try to think like that. I mean, even here's was a light bulb moment. This paper company talked about needing, and the numbers are just meant to be directional, 10 cars 3 times a week at a plant somewhere in the Southeast, and was getting 2, 8, 12, 15. It would always, therefore, start to over order. At times, it got everything it ordered on time. Not enough, right? It should always be. And because of that, they had more cars than they literally had room for. Meanwhile, there was probably somebody who wanted that car somewhere else who wasn't getting it. So everybody was gaming the system. The information systems that work now work for a single part of that, a single node for that paper company, gaming the system. The system is disadvantaged by it. RailPulse is trying to make the system, the rail network, advantaged. It's trying to do this in a way that is open and is not specific to, for example, the class 1 that is a co-founder, Mike McClellan in Norfolk Southern. It's trying to make the rail system better, because paper, as a classic example of market share loss, a classic example of an industry almost obsolete. I read 4 newspapers a day. I bet you nobody else in the call does, but we all get Amazon packages, right? And so that industry has got real share and a potential. And here we're playing in that game. And I think, one could argue this is just a minimal ticket to entry. But we had seen share loss to trucks. In that original pilot example, some of the railroad people on the short line panel said, as they were discussing the idea of doing a mini rail pulse, if you will, with one shipper and looking at this, they went to the plant in the Southeast, and in the plant were trucking desks, literally a desk of the trucking company that it would use. Why? Because they were used all the time. It made more sense, since every day the railroads failed and they had to turn to these guys. That doesn't always work in times of truck shortage, but that's not, you can't count on the failures of your competition. You got to get better. And RailPulse is a classic example of what I call offensive, from a football sense, where both offense and defense are important, but an offensive technological breakthrough. And really, it's not as much a technological one as I said before, it's a diplomatic one.
Thanks, Tony. From Scott Sigmund, what do you see as a longer-term virtual decentralized stay-at-home office impact for railroad staffing, management, sales and marketing, and operations?
It's an excellent question. It's not really my specialty, but you may have heard us, Scott, talking about this before we went on live. I care about it a lot as an urban person, as someone in New York. What is it going to mean? Midtown is still empty. And I asked a big transportation banker that some of you may know, you back in your office, he said it would take our office, we have 3 floors of a Midtown building, it would take us all day to get up into it, and then all day to get out of it again at 2 people per elevator and all that. When all this changes, Kansas City Southern was talking about 40%, going from 100% at their main office, 100%, let's say the 100 people at their headquarters, I'm making the numbers up, 40 would stay there on a regular ongoing basis. Now that 40 would change, right? People would have 2 days a week. It's going to change things a lot, I think. But I also, I guess I bet more on change is always anticipated to be greater than it really is. Like the first round is not as dramatic. I am hopeful as a citizen that cities come back. I don't know what this means. Railroads have the same problems in headquarters as everybody else does, and therefore the same solutions. They have the advantage of a lot of what they do is isolated or semi-isolated and outdoors and whatnot. I know that they're getting hit in the second wave, and it's happening in places where the Dakotas and others, and that's not good for railroaders. But when all is said and done, I think they're going to be slightly, have more options than industries like the big banks that are in Chicago and whatnot. I mean, it's a really good question. That's the kind of after lunch at the bar question, because I don't have any expert opinion. Every article that comes out in the Times and the Journal and the Financial Times on the future of work, I read because I'm just really interested in what's going to happen to Midtown Manhattan and the Loop in Chicago and the Kansas City Southern headquarters building and whatnot. I've worked at home for 20 years. I'm sick of it, man. My work at home used to be going to Chicago, and whatnot. And now, I think you people gain a lot by human interaction. And it's my gut feel and my hope and I don't know how to separate them, that we'll come back to that way of thought. And then so instead of, 2 or 3 out of 5 staying home on any day, it's 1 out of 5. That's what I hope. But I'm telling you what Kansas City Southern told me a couple months ago.
Tony, we had talked about wrapping today's session at about 1:30. I want to make sure you've got time for more questions because we have a lot more in the queue.
I do. I'm just watching my rig a la Tony get cold, but
All
this
our
is
meals
just
are getting
exactly
cold
like
too.
if I were there at Mangiano's, I'd have 2 bites of it, get up and speak, and then, so we're playing the game the way it should be played.
All right, here we go. From James Daly, is the involvement of private equity players in the railroad industry, particularly short lines, detrimental to capital expenditures?
No, not at all. I mean, for infrastructure firms, no, they're long-term investors. One could argue, and by the way, private equity firms are involved only in the short line. They're not involved. I mean, I don't know what you want to call Berkshire Hathaway, but they haven't been detrimental to capital expenditures. A classic private equity as opposed to an infrastructure investor. Some of them have been known to be asset strippers and throw on debt and whatnot. I don't think we really have many examples of that in our space. We've seen their arguments about what companies like 3G, and I don't know enough, I'm not trying to pick on them, did in the food space, right? Buying Kraft and whatnot and cutting heads and getting it ready for sale, goosing the numbers over the short to intermediate term to create a higher value for sale. I don't see that happening in our space. And if you think about if you think about Brookfield, that is not what they do.
Somewhat related from Tom Corneli, but I can't really read. Could you talk more about what changed to make short lines such attractive targets for acquisition?
A great question. And I don't really know when it started. They've always been attractive to some, and they've always been these holding companies out there looking to buy. And there have been elements within industrial companies who want to purify the company, right? Get rid of the lines attached to a paper company because they're not in the rail business, they're in the paper business. And now we see Transtar selling, right? And so that, some of these things you can contractually get the business you need to keep your plant running, but maybe that operation ought to be run by this. So that was a start. You have infrastructure funds who own ports and airports and toll roads and utilities, and they don't own North American rail. They own rail in Australia, a world that's reasonably similar, a place I've been numerous times to look at their railroad. So their experience was such, a lot of these big infrastructure firms are in Canada, where they hear about the successes of CN and CP all the time. A confluence of events. The latest round was already going on. You saw Fortress buy some and then sell some, and you saw, et cetera. But then you had CSX going through, the first U.S. railroad to go through PSR, and Hunter, who in his career was much more of a buyer of rail assets than a seller, did look at this, had operating ratio goals, and said, we have the chance to rewrite this whole thing. And here we have 6 lines with more to come. That turned out not to be true. And we're going to sell them. And then all of a sudden, these sales and the high rail trips, they were really funny at first because I brought, New York, London, Sydney, and Toronto bankers, put them on a high rail car and said, here's the line. And they said, well, no, I'm looking at a book. Like, what are the revenues? Oh no, here's the line. And it's sort of like these 2 people were talking, different languages. But as they figured that out, that helped, stimulate a sale. I will tell you that the, Florida East Coast sale was very, was the interest was massive. The interest in, when Fortress sold that, their short line property out, that interest was massive. So it has always sort of been going on because infrastructure firms, which is a reasonably 20, 25 year kind of occurrence and have gotten bigger, have looked at sort of the one hole in their portfolio as being North American rail. And there've been a few sort of unique, sizable pieces where you could pay a lot of money, but but you would all of a sudden have a platform, right? Those are getting fewer. They still exist, but they're fewer. There are a lot of these one-offs, and there's a lot of money out there that wants to find a home. They get well paid to run these long-term asset stories, but they need to get the right one. So you have more money than deals, and that always drives the valuation up. You also have a generation of short line entrepreneurs who bought their lines from class ones and others in the 80s. getting to the age where, you know, either there's a new capital cycle about to be involved, or they themselves just want to go off and work on their golf game. All these things have come together. But I really think, you know, a red letter date with CSX announcing they were selling lines. They ended up selling less than they said, and all that. But, you know, then the race was already started.
Thank you, Tony. From William Miller, during the last year or two, Chicago hasn't been the national bottleneck that it has been in the past. Is that volume-driven trade wars, COVID-19, or is it from real improvements?
Both. If somebody once said to me, if Chicago isn't a little bit of a problem, then we're having a national problem, meaning there's just not enough volume. So, I think they've been working to chip this away. You got the J line, you have had technology improvements at the belt, and I think there have been efforts over time. You know, there was never a silver bullet. Create, for God's, I can't believe I didn't just say that right away. Was short of what was originally desired out of it, but they have been working very hard for a long time now, and every time they open something up, it's a little bit better. And Bill and his team have done, I think, a really good job. I wish they'd had more money in the beginning, but you play with the hand you're dealt. And right now, of course, but on the other hand, you're seeing a huge intermodal explosion, and everybody's talking about the problems in the West Coast ports, or they were, less so now. Part of that is crews had gone home, and everybody was sheltering in place. That's not necessarily a real issue. But in this big run up, a lot of those trains would come in through Chicago. You're not really hearing about it. I think that so your combination of they're getting better and this crazy time we've been in. Chicago is never going to, if it works like a dream, I'm thinking there's not enough food in the pipeline, kind of thing.
Thanks. From Bob Peskin, could any operator, Amtrak or others, profitably run a rail-based mail or packet service in specific corridors or even nationwide, though he himself?
I don't know the answer to that. That's been tried before, but you're competing with some very sophisticated, deep-pocketed people. Why would you want to? Why not just help them? Does Amtrak, let's say you had that deal, you got a deal to do big distribution on Amtrak, and now you have no passengers, so you've had to cut back service. What happened? What happens then? I don't think you paid enough to run an Amtrak train without people on it. From an ROI perspective, I don't know the answer to that. I think in some ways they do that now through hauling what now are with so-called short trailers, of UPS and JB Hunt containers filled with Walmart goods. So to some degree they are part of the process that moves packages to me short haul. But I don't know of a specific different thing like that. I've got to tell you though, I mean, it's a really good question, and it's worth thinking. Big thoughts. It was Rob Riley who went from BNSF to the CN to be their COO, who first sort of, another light bulb moment for me was when he said, look, if we don't worry about the cost of starting a train, I mean, obviously there's fuel, but fuel looks like we're in a long-term, benefit. Plus it could be battery powered. They're already testing, whatever. If you take labor out of the equation, we do so many things about crew starts. If we didn't do that, I could run, and we have so much capacity available, I could run short haul trains at higher speeds. It may take capital, but all of a sudden the whole way you think about how to run a railroad changes. And so maybe the freight railroads themselves, if they get autonomy, and again, the technology is just about, if not already there. The question is, can we make sure we don't get two-man crews, legislated, which is insane, but not impossible, things like that. So.
Tony, are you game for a commuter rail question?
I love commute. I take commuter rails when I commute, but I don't really know much about them. I know it's a really big deal in Chicago, and I'm aware of them, and I've seen them all over, and I've taken them out there. But that's really a better question for Norm.
All right. Well, we'll hold that one for now. I'm going to go with one last question. I think at the timing we have, and then I'm going to ask Norm to come back on. And I would ask if you have, there are some additional questions hanging out here. Tony's email is on his slides. We're going to send them out after the meeting. If you'd like to follow up with Tony,
please do.
With your question, I'm sure he'll take it. So the last question I have right now is from Richard Gill, and he asks, do you expect the cold traffic decline to to result in massive reduction in scrapping of railroad infrastructure.
A massive reduction in scrapping, or a
Yeah,
reduction in
like getting
infrastructure?
rid of lines, I suppose, that are currently servicing coal.
This has been something that's been on the, it's been going on for a while. In the West, I don't know what's going to happen to the lines into the Powder River Valley, but the rest of it is, main infrastructure. In the East, you have lines completely dedicated to, coal that could be strapped, but, massive, with the exception of Appalachia, most of the coal business goes on lines that are used by other things. So no, I think, you're sort of, when we look back in the fullness of time, we'll see that whatever changes will have happened are already happening in terms of reduction of the fleet, or, ordering fewer coal cars, that kind of thing. And the same with the, physical assets. I don't know. It's a difficult question from a lot of political point of view. If there's a line in West Virginia that covers a couple coal mines, does the short line want to necessarily buy it? Does it have other options, other opportunities on it? Is it, not very large and then connects to a main line between Charleston, West Virginia, and, whatever? I don't know the answer. I don't, but I think I don't think it's going to be massive. Like one day we're going to see an announcement of $1 billion write-off or something like that. It will be interesting to see what happens. The only ones I know are purpose-built that don't necessarily, carry anything else. And correct me out there at Mangiano's if I'm wrong. Are the lines that they're run by the BNSF and the UP into the Powder River Basin? They connect to main lines, but they also had shale opportunities, but that's not looking so great either. What happens is we continually hit. For a while, the Powder River looked like it might be, if not immune, then less impacted. And there are, of course, export potentials out of the Powder River, but that runs into its own set of, of political issues. So I guess what I'm getting at is I don't know. That's a lousy question to end with. I don't want to end my my whole 2020 year with I don't know, but I guess it's par for the 2020 course.
Well, maybe Tony, let me just give you a chance to wrap up again and say, what is your outlook for 2021, and where are the, and where do you think rail is going to have maybe the most growth next year, or where do you think the strong market opportunities are?
So it's been a weird year in which ag has really been one of the stable forces. Whoever thought that grain would be a stabilizing force for railroads, but the comeback of autos, housing and forest products related stuff, packaging related stuff, and we've talked about, and intermodal. And I think those things are all going to lead us next year as well. We expect big harvests in both sides of the U.S.-Canadian border. There is ready appetites for the product right now. Things look unusually stably good in that field, and I think intermodal will return. The comparisons starting with the second quarter are going to be ridiculously easy, so it's going to be harder for us to parse what's really happening, and it may not be till 2022 that we get a normal year. Will we take the tariffs off the Chinese goods, since that policy obviously doesn't work? Doesn't mean we shouldn't address Chinese issues of stealing technology and all sorts of other things, but those aren't rail related issues. Intellectual property is not rail related, but soybeans are, and electronics and furniture are, and things like that. So, I don't know. I have hopes for a good year, hopes in which service will improve and will impress all the folks. And we get back together, for example, at the Intermodal Expo, and 50 to 75 Amazon people will try to be incognito, wandering around there, and I think they'll be impressed. I think that's going to be a good thing. So I have hopes that it'll be a good year next year, but compared to what? So it's
Let me ask you another related
I will
question.
tell you that none of the railroads, let me just say this, the railroads have had no guidance, and I always think they used to give too much guidance. We're going to earn this, that, but they suspended their guidance at the end of the first quarter, and they have not reinstored it. So that means they're not getting guidance from their customers. They said in January for the fourth quarter results, which themselves aren't as important in this fourth quarter, but January meetings, the webcast will be really important as they try to tell us what they think the world will look like and when we'll see a return to normalcy. But I think I still want to put too much stock in that because I don't think they really know. And, under a more stable administration, and forgetting everybody's politics here, from a trade perspective, I expect that 2022, I have hopes, is the new base year. And so when we look at 22 and when we expect 23, that's a ways from now. It's a lot of rigatoni and Mangianos between now and then. I expect that that's when we'll really know what's happening.
Well, let me ask you one other related question. Where do you see Rail's future with respect to servicing e-commerce, and what can Rail do to be a bigger player?
So I just mentioned the Amazon people. There were 50 of them at the last Intermodal Expo a year ago in Long Beach, and then we had a virtual one. They're different, and Amazon's just one example. Walmart, major e-commerce player, goes to the railroads often in a JB Hunt box. Others as well. Amazon, as the example of e-commerce, chooses to deal directly with railroads rather than use an intermodal marketing company or some other intermediary. They do this with all their guys. They have really hurt some of their erstwhile partners like XPO and others by giving the business and then really replicating it themselves. They can't disintermediate a railroad. They can either use them or not. Right now they are. It's a fractional piece of their business. But I think that, as e-commerce changes, railroads are going to participate with the inbound from wherever it is, international business, whether it's China. And by the way, the idea of selling China, forgetting the government as a trade partner short, be careful about that. There's too much infrastructure there. But, inbound goods, paper goods, to wrap them in. And the battleground is domestic traffic from major DC to major DC. You need to stockpile stuff near New York so that I can order a book and it comes tomorrow, which is insane, and now I'm used to it. So somewhere they've got to have these warehouse cities, and railroads could, that gives you size and density, and railroads can play. And they're doing it now in the so-called pup trailers, and the 28-foot trailers and others. And I think they could do it in the containers. And when you see that the biggest customer is still UPS, when you see the huge size of JB Hunt out there, that's participation. That's a lot of things, but in that is e-commerce. So I have high hopes, and I have hopes that the railroads have kind of in the nick of time begun to catch on from a technology perspective and understand where the game is changing. These new generation of leaders and the next one that's coming will be much more tech savvy. Will be, everybody has Amazon at their own house right now, and I'm using Amazon as a e-commerce writ large. There isn't anybody out there that's like the leaders that when I started, who lived a life that was radically different from everybody else. Their house may be bigger, but Amazon still shows up every day, and they wonder, how did it get here? What did it travel on? And so I think that's the future.
Hey, Tony, related to that, do you think shippers are going to go to the railroads and intermodal mostly when trucking capacity is tight? This, thinking of e-commerce, or do you see them relying on intermodal as a first choice?
Well, I think it's going to be all of the above. It's if you can provide enough density and size, and then and railroads can provide the reliability, then you save money on intermodal. So intermodal is a first choice, but it's not the only first choice, right? It may be the second first choice. They will also go back. I think the railroads had a big missed opportunity in 2018 when trucking was really tight, in a large part due to regulations, onboard recorders and whatnot. If you looked at the numbers after that year, intermodal did really well, but it did mostly really well in the trailer side because the railroads didn't provide enough container capacity. And if you provided container capacity, it is my opinion that is stickier business. So the railroads would have retained a higher percentage. As it is, all that trailer business went away the next year when trucks, did the classic cyclical thing. Well, it was a really good year. I raised my rates. If I just put up more capacity at these rates, then I'm going to make more money. But if everybody does that at the same time, then you don't have those rates anymore because you have too much capacity. Well, the trucks did that, and all that new rail business went away. I mean, not all. I'm being very simplistic here, but I think that was a missed opportunity to gain stickiness. I think the secular trend of railroads gaining share in intermodal will continue. Larry Gross and I could argue about this. What is the rate of that? When CSX, who is right now arguably the second player in intermodal in the East after Norfolk Southern, but when they talk about growing their intermodal on a secular basis at 2x GDP, so what is that? 4 to 6%. That's not what it used to be, but it's pretty good. And they're the number 2 player, so maybe Norfolk Southern should be 2.5. These are off the top of my head. That's the kind of, that's a share gaining opportunity. I think they have I think their problems are never behind them because the service bar goes up every year. So, like a dog catching a car, the car finally stops, the dog caught it, thinks it's great, and the car starts again, right? So railroads are sort of in that position. I'm hoping that through technological advances, through new mindset changes, through PSR and its impact on other pieces of their business, that they understand that car will always change and not smash into the back of it like the dog does at a stop sign.
Yeah, just one other tag team to that. I'm sorry, I'm kind of hijacking the Q&A here because we do need to wrap up. But related to that, how do you, and this was a question that was asked earlier by another participant that I didn't get to, but related to this, how do you think shippers perceive service levels provided by the railroads now? Is it competitive enough to support e-commerce activities?
So it depends on who asks. If the person that asks is an STB commissioner, I think they're really upset about service right now. If the person who asks is a legislator, I think they think service is really lousy right now. If the person is who asks somebody like me, I think they think, well, yeah, I didn't really like PSR 2 years ago. It's pretty good right now. It's pretty reliable. I got other problems. Rail service has had short-term problems this year because of staffing and other things related to the pandemic. Probably no different than the shippers themselves, right? You send everybody home because there was no demand, and now you needed everybody back, and not everybody could come back for a variety of reasons. Hopefully, mostly good. Railroad certainly had that around the Port of LA Long Beach, but so did every part of the supply chain out of the Port of LA Long Beach in the recovery. Railroads are not used to and not built for 40% declines and 30% increases in the course of one season of the year, in the spring and early summer. And so that's crazy level of that. And I think having done a pretty good job in that, I think shippers they're never going to be happy. It's their job to be unhappy. There's always friction. Nobody's going to say it's so good. You should be charging me more. But I think they're pretty happy right now. And I think they'll be happier next year, assuming that COVID, wanes, goes away. Knocking wood to say that, I think that we've taken a stair step in service. Service has been getting better by the metrics we saw, every year in the 21st century till around 2015, 16, when it seemed to kind of stall out and then decline very slightly, but decline consistently, especially at the three carriers that converted to PSR in the United States. I never really knew why velocity was going down and dwell was going up at Norfolk Southern, but it did it for like 55 straight weeks. A little bit, right? It wasn't a crisis, and Chicago was a problem. It wasn't a crisis. This wasn't UPSP. But I think since the changes, the operational changes, service has gotten better. I mean, and basically what you saw, the pattern was radical changes in Canada, annoys everybody, but they actually get the work done. They all huddle back together. Maybe you put a new person in front, Hunter moves on somewhere else, and you come back and you're kindler and gentler was one of the phrases. You re-engage with your stakeholders with CPs, then you pivot to growth. I think that in the US example, they are in that process right now. I think they were much more collaborative, using a Norfolk Southern phrase, in their PSR efforts because they were aware of the STB was pretty angry with CSX in their process. So I don't know that you had the levels of anger that you might have had in 2017, 18. It's a long-winded way of saying, under a kind of normal-ish year, it won't be a normal year next year because it's going to take a while to get everything back and all that. And we don't know where downtowns are going to be, and all these sorts of things. But I think rail service is not going to be one of the problems that shippers are going to face in 2021. That won't be on their big list of things to solve.
Thanks, Tony. I think that's a much more, it's a much improved subject to end on in a positive one. And I would have to say, one of our railroading friends, and we wish him the best of luck with his retirement, Rob Martinez from Norfolk Southern.
Oh, yes, Rob.
Let's look forward to the new abnormal of 2021. So with that, I'd like to invite Mr. Carlson back to the screen to wrap us all up.
Hey, Norm.
And thank you very, very much, Tony. Interestingly enough, you addressed the answer to what would be a big help for the commuter railroads in COVID, and that is to figure out what I call the problems of vertical transportation, i.e. the elevators. And as long as people cannot come to the downtown offices because of the elevator capacity, that is a problem for the commuter railroads. So that, and on that topic, we hope to have Jim Derwinski, the CEO of Metra, speaking at the January meeting. We're working on the coordination of that.
Good.
And I think that you'll hear about the many things that we are doing at Metra, including My Metra, which is a focus on bringing the passengers back and giving them confidence that they can ride safely on a commuter train, safely from the health point of view, as well as the physical point of view. But again, Tony, we always enjoy this. We truly appreciate the time you give to us. We truly appreciate how much you value participating, and we look forward to getting back together in 2021. And with that, I think we will close and hopefully get back together with another meeting in January.
Thank you. It's the highlight of my year. I just hopefully it'll be a better highlight next year when we're all in person.
Correct. And with that, the meeting is adjourned.
Happy holidays to everyone and happy New Year.
Yes.